sun.
That's what happens when you grow up in Ireland.
Well, that's it. You get a permanent shade of white. Well, listen, it is December the 15th, 2023. Hard to believe, the last day of our podcast year. So we'll start off by asking everybody to sing Merry Christmas all together now. Now, Brent crude oil trading this morning, a bit Christmas-like for those who prefer when the prices are moving up. We've got Brent trading at 76.81, and we are on the doorstep of perhaps the first week in 8, where we're going to finish the week in an upward level from where we started it. And WTI also over trading yesterday got above $71. So we'll get a sense of where we're at in the immediate, and then where we're going to sort of think the world will go, and markets over the course of the month that we will be away. As we are always still traditional and courteous here, ladies first, Dr. Carol Nachley, CEO of Crystal Energy, return to Abu Dhabi, which is wonderful, and we hope we'll get a chance to see you. But Carol, your thoughts, mid-December, markets finally sort of maybe have hit their bottom. The momentum out of the OPEC Plus decision didn't give it much of a lift, but it seems the end of the rate tightening cycle, Fed signaling cuts, that's the difference now. Your thoughts on that being the difference going into 24?
Good morning, Sean. Good morning, everyone. Well, look, I mean, definitely we have had some positive signals coming from the market, from decision makers, particularly from central banks in the US, the Fed, because in Europe we still have a bit of different tone. But still there is cautious optimism that maybe the tightening of the interest rates cycle has come to an end. That said, I say cautious because inflation is still high. It is getting closer to this Federal Reserve's target of 2%, but usually they say that is the last bit that is the hardest to achieve. And maybe the market was looking for just this kind of positive signal after so long of bad news and cycle tightening. But this does not mean that the interest rate are going to be cut suddenly in January, maybe, but I think it's too early. And this does not mean that we're going to see a boom across various economies. And also what will happen with other central banks. We heard yesterday Christine Lagarde saying it's too early to declare victory, and they are being much more careful with announcing any news about potential cutting of interest rate. So while there we have had this positive signal, and that's what has contributed to this rally to a certain extent in markets, including in with oil prices, we saw this upward pressure after this kind of positive news. But I would say it's not going to be suddenly turning the page to a new phase next year. Don't forget, there are still the effects of the tightening of the interest rate that will have to be felt across economies in the US and around the world. And we should not forget that China is still lagging behind other economies in terms of growth.
Adi Msirovic, Director, Surrey Clean Energy and Senior Associates, CSIS. Adi, is this more of a technical rally? Ultimately, the market had been oversold. The shorts had come back in. Your thoughts as the energy minister of Saudi Arabia likes to call them, the speculators sort of turn this market too much in one direction.
I do think, purely from trading point of view, that the market was overdone. There was too much bearishness, especially given the fact that the United States was showing all the signs of resilience in the economy. It was just waiting for some positive news. And rather than repeat what Carol said, I totally agree with that. I think it was basically what we've seen is a risk on rally. There was also some fundamental underpinnings of this mini rally, if you want to call this. If you look at the prompt situation, the Brent was dated Brent was trading negative all at the front end of the curve. The front CFDs have turned now positive, even though the spreads are still extremely weak. They've got quite a bit stronger in the last 2 days. Nigerian barrels have cleared up largely. India have been buying some Nigerian barrels as well. So the very sort of basic front end physical market has actually picked up a little bit. Now, we have to be still very, very cautious again. I agree with Carol, because there are a number of things that may actually cap that, including margins, runs, China, and other things. For example, diesel stocks have actually picked up. That was one of the most bullish things out there in the market for quite some time. They've really built up quite a bit. We are out of gasoline season, so that's not going to help us. And actually, Chinese teapots are actually cutting runs at the moment. I think this morning I just saw some very brief news from Reuters that Chinese imports in November actually were below October again, and they were just somewhere at the average of the year, which basically implies, obviously, because it doesn't include stocks necessarily, implies no growth. So yeah, I think there's plenty to talk about here.
Bora Barryman, managing partner, Hormuz Straits Partnership. Bora, what do you think is the dominant trend that is currently ending the year with? I mean, we've got OPEC supply cuts, through the year, and then again, only recently, end of November 30th, the announcement of even more supply cuts, and then quickly after that, we had the Fed sort of complying with the market's outlook that cuts are coming, or rate cuts might be only around the corner. Geopolitics continues to roar. Ukraine seems like losing the momentum there of support. China out. Where do you think, which of these is driving the direction of the market as we come to the end of the year?
From my perspective, when a Fed is easing, it's an indication of a reaction to a worry, and I think the worry in the market, especially from the American perspective, is not about growth. Their growth is fine, their employment is fine, but there's an uncertainty about geopolitics, about financing the wars, and of course, just putting that aside, the huge debt service for both the private sector and governments, which have an impossibly large debt interest payments and refinancing challenges that are imminent. For example, foreigners are not buying U.S. debt, and the pressure's on for American hedge funds to pick up the burden and finance the huge funding requirements of the U.S. government. So what the Fed did was, look, I'm not going to pinch any harder. Things might be easing up, so that's the message. Don't worry about inflation. We can argue about whether they declared victory over inflation or not, but certainly they're saying that's not the worry, and we're ready to kind of put more liquidity into a market that was doing well on its own from a day-to-day basis. But again, the real worry in America was really about refinancing and the ultimate resolution of these building debt burdens. So, and again, I would say let's remember that the Fed does not have to follow its own forward guidance. Only a few months ago in September, the guidance was that there would be a rate hike by Christmas. Clearly, that's not happening. So, them indicating that there would be a 3 notches down in 2024, it does not necessarily indicate that that's where we're going to go.
I mean, I was always of the view that the central bankers, and particularly the Fed, would want to get off the stage before the first primary in the United States, which is in January. They do not want to be part of the political game that happens once that gets underway. And I'd suspect that why I don't think they will cut mid-year next year, unless there are some serious economic problems, that they do not want to get on the stage in the middle of an American presidential election and start supporting the presidential candidate with some cuts. I don't know. That would be my general political intersection point here. But Carol, I wanted to get your thoughts on what has been a sort of I would say an increasing thorn in the side of the energy markets, oil markets in recent months and or maybe through the year, and that's the divergence of OPEC and IEA. They seem to not like each other very much at the moment, but also their numbers are so different. The IEA did come out this week to correct or to revise upward its demand outlook for the growth for next year. Looking at above one, but still it's about half of what the OPEC is forecasting. And I'm wondering, from your point of view, where that divergence, the IEA is at about 1.1, OPEC plus is at 2.3. How do we get, where do we go with those? What impact does that have, do you think, on the market sort of volatility?
Yeah, it's interesting that you mentioned the divergence between OPEC and IEA, but interestingly, I mean, first of all, divergence in forecast is pretty common, but yes, we used to see more of a closer expectations on demand. But the bigger divergence for me occurred, if you compare them in history, started particularly with the Biden administration. The Biden administration came to power. It could be pure coincidence between like external factors that have nothing to do with the administration, but that is something, an interesting trend to see that the divergences increased in the views expressed. In the forecast, perhaps until recently, where the demand outlook was pretty much similar until last month. I think the IEA significantly downgraded its forecast for demand, whereas OPEC maintained its more optimistic forecast. Now, if you look at where the demand is coming, primarily with the OPEC forecast, so they say demand growth is going to be 2.2 million barrels a day in 2024. 2 million barrels a day, so approximately 90% of that forecast, of that growth, is expected to come from Asia. And I think this is where primarily the main, perhaps I didn't check the numbers in detail because IEA's forecast just came out yesterday. This is, I think, where Asia, I think OPEC has a more optimistic stance on what is happening in Asia with China in particular, but there are outside OPEC bigger question marks raised about the strengths of oil demand, particularly for the domestic market, for domestic consumption, not for refineries and re-export. There are big question marks about whether that is going to be as robust as maybe the OPEC is expecting. That said, if you look at other agencies such as the Energy Information Administration, you can see also from their outlook, the short-term energy outlook, oil market outlook, they did downgrade their oil price forecast for 2024 by $10 to $83 a barrel. So there is more caution outside OPEC about the outlook for energy markets, and it's not just the IEA, but I agree there is almost 1 million barrels or 1.1 million barrels a day difference in gross demand between IEA and OPEC. It might converge as they usually do, or it might continue to diverge in the coming quarter or months.
We had some big supply deficit numbers from both of them for Q4. I mean, the OPEC Plus had it as up as demand would exceed supply by 3 million barrels a day in the fourth quarter. They held on to that for quite some time. It's hard to know. You're hearing, Adi, increasingly hearing credibility questions of OPEC Plus numbers, IEA. I mean, they criticize of each other, but also the market watchers criticize both for their the credibility now is in question, I suppose. And I want to get your thoughts on that, and particularly through the prism of market credibility, which for so long with OPEC Plus had been rock solid through the COVID and subsequent years, but now seems to be fracturing a bit. Your thoughts on the recent OPEC Plus meeting, the signaling for the new year and the additional cuts. How do you read that? Do you have credibility concerns that they're arriving at a difficult time in their phase of cycle of relationship, and with Russia's compliance or not? Your thoughts on that?
Yeah, thank you, Sean. I think we could just do a whole program and just and I think it's very interesting, and I'll try and link a little bit last OPEC Plus meeting and the sort of the numbers. As Carol said, I think the important thing is that whatever the numbers, EIA and IEA seem to be in line. So if you look at the three of them, it seems to be that OPEC numbers sort of stick out like a sore thumb for whatever reasons. Now, as Carol said, I think this year about 80% of all the demand growth came from China. So if you have that in mind for next year and knowing what's happening in China, I think that I would probably put a lot more credibility on the IEA and EIA numbers simply because of the sort of Asian demand and particularly Chinese demand. So the key issue, I think, here in terms of credibility is if I was at the trading desk right now, I would disregard OPEC numbers completely, because if OPEC secretariat really, if OPEC countries believed in their demand figures, why on earth are they going on and talking about further cuts if demand is really going to be that high? So the problem is this year we've lost, even IEA numbers were corrected by about 400,000 barrels in the fourth quarter, which means that demand is really, really weak going into 2024. And we really need it. Obviously, and things can change, but we do need a miracle to see something better. And the reason the market's gone down to close to $70 is precisely because the market saw this. The market saw this really weak demand situation in China. Macro situation was rather poor. And what we've seen in the last couple of days is positive news from the United States in terms of rate cuts. We saw a big fall in dollar. DUI dollar index came off, I think, about 3% in like 2 or 3 days, which also will boost demand because other people outside the United States are buying in US dollars. Weaker dollar means sort of weaker sort of crude prices overall for everyone else. So we've seen some little bit of positive signs, but overall, the market's been right so far, and it's been pretty poor demand globally.
Bora, I wanted to get your thoughts on the recent, this week we had the big announcement out of Dubai, COP28, and I suppose the headline that the most grabbed onto was the use of the word fossil fuels and the idea of moving away from fossil fuels was sort of the thematic of the final communique that 200 countries signed off on. Of course, nothing happens overnight. There's no legal impact of this agreement. But I wanted to get your views from a banker point of view, because the first thing I thought of, well, maybe this has no immediate compliance obligation, but sentiment-wise, my thought is that bankers, it might be extra sort of, the pun intended, fuel to incentivize bankers to back away from funding long-term hydrocarbon projects, a 25-year refinery, whatever it might be. Your thoughts on the impact of the COP deal on bankers and financing the hydrocarbons industry over a sort of 20, 30-year cycle?
It is a difficult challenge for bankers to take a view on these points, and I think that that's why the national oil companies are getting a stronger and stronger position in the oil industry, and perhaps the independents are being pushed to the sidelines. And it's also a issue of course for a production in emerging, or I would call them frontier markets like Africa. Investment into the upstream sector in sub-Saharan Africa, an area that I focus on, has really dropped off, and it's part of a overall dive in foreign direct investment into Africa that had been growing since the beginning of the millennium. Through COVID, it's come down and hasn't recovered over the past 3 or 4 years. And I think there's uncertainty about these regions and the hydrocarbon sector. What I am hopeful of is that actually the COP28 commitments will be supported by mechanisms to actually invest in the energy transition in places like Africa. That's a place where OPEC was hoping a lot of their demand growth would come from, but I think there needs to also be investment into electrification and grids and solar projects and solar storage projects that are becoming very interestingly scalable these days. I think it's an area that we all need to focus on, and I think COP28 was encouraging in that the Saudis and the UAE, they seem to put some strong intentions of commitment to fund these new technologies and scale them into the developing world.
Well, there was certainly I mean, one of the other big headlines was tripling of renewables, which is a fairly massive concept, and the a date being much earlier. I think that was 2030. So 2030 tripling of renewables, and 2050 phasing down, moving away from, whatever language you want. And like most big multilateral agreements, everybody can sort of read the tea leaves as they want to and find some positive outcomes. But nonetheless, I think sentiment and people I respect who know this space much better than I do call this agreement historic, in that sense that it did include fossil fuels and some commitment to acknowledge that it is in the it is in the problem box, and it is also part of the solution box. Let's go to the survey question, which again sort of turns our conversation, our last few minutes together, towards the year ahead and what is likely to carry over. Which 2023 trend will carry over and determine oil market direction in Q1? I mean, all of these will, I suppose, but which will be the biggest impact on the oil market direction in Q1? OPEC supply cuts, end rate tightening, geopolitics, China eco outlook. All of the above, sorry, not there. Carol, looking to the month that we will be off and the end of the year and moving into the new year, obviously we still have a raging war or invasion of Gaza, big geopolitics still out there, you know, other elements of uncertainty. Your thoughts about what might sort of determine the direction of travel and some of those big stories that are blazing away?
This will allow me also to comment on the poll, because if we highlight geopolitics, and you can see it's amazing what is going on around the world. You have the war in Ukraine still ongoing, the war in Gaza still ongoing. You still have sanctions on major oil producers. Libya is far from being stable. Yemen, Houthis attacking, oil tankers, a Norwegian oil tanker, and still oil prices went in the opposite direction that they would have gone to only a few years ago. And this tells us there is something much more powerful that is dampening the geopolitical risk premium. And that is partly because, yes, the market is well supplied and demand is not really roaring back with vengeance, as many would have expected for this year. But also there is a lot of spare capacity in the system. And that's why I would never look at the geopolitical risk without taking into consideration the spare capacity. And that spare capacity is to a large extent because of OPEC cuts. So while OPEC is trying to put upward pressure on prices, they are also helping in a sense to dampen the geopolitical risk premium. And if that situation continues, I think, of course, geopolitics can still have an impact, and it depends on their scale. But at the stage we are facing a cocktail of very important developments on the geopolitical fronts, and yet the oil market is barely taking notice. And that's why I will refer to what would be, in my opinion, the most important indicator that I would follow closely next year, because OPEC cuts, how much deeper they are going to go. What they announced was partly expected, the rollover of the Saudis and the Russian cuts, and the Russians, is it production or exports, leaving everybody confused. But if you look at the other members' contributions, they are very small compared to the baseline that become effective from January. So for OPEC cuts to become more effective, we need to see much deeper cuts coming into the system. Demand has to play an important role because non-OPEC supply will continue its growth into next year. So for me, the main factor that will determine the direction of the market, take into consideration everything else happening, would be the demand, and it's primarily China.
Adi, just picking up on that and getting your thoughts. Obviously, big news overnight. The EU couldn't agree on the 50 billion for Ukraine, following only days after the US failed to do the same thing. But yet there was the big good news for Ukraine in the sense of the access or the on the pathway to membership of the European Union. Adi, your thoughts as we end the year on the geopolitics piece, but particularly in the context of Ukraine and its weakening position vis-a-vis support from the West?
I think it's a very interesting point. I think especially as we are going into the US election, that issue is going to be more and more important. I think the limelight was taken out of Ukraine because of the events in Palestine. So the US Congress is playing it hard as well, hardball in terms of funding. I think it's going to be a very tough time for Ukraine. A bit of a boost for Putin, I guess, but I think at the end of the day, Europe will get their act together and try and sort of make up for any loss from the United States. Even though I don't think there'll be loss at the end of the day, I think the US will continue to fund Ukraine because it's extremely important, not just for Europe but for the United States. But generally, geopolitics are going to get worse rather than better, partly because of the situation of the elections in the United States. I think it's going to be a very volatile period from the political point of view. We know that the Saudis are definitely not there for Biden. They don't want him to win. And they'll do everything to try and maintain high oil prices, which would hurt his chances of a re-election. But I think overall, OPEC 100% agree with Carol. I think, as Bill Clinton used to say, it's about the economy, stupid. I think we are at that point of intersection of demand and the supply curves, where further, because of the weakness of demand, the further cuts that OPEC make only reduce their revenues. So every time they do a cut, even if they stick to it, they'll just reduce their revenues because there's plenty of supply out there. And I would expect the call on OPEC, and I think it's not just me, it's basically the IEA that are saying the call on OPEC is actually going to fall early next year in the first half by about 500,000 barrels, which is quite a bit. So basically OPEC is going down to like 27 and a bit million barrels call on demand for their crude. So they're almost becoming far less relevant. And in the age of energy transition, every time you push the price up, you're just basically shooting yourself in the foot and accelerating that transition. So yes, geopolitics are going to be important. Ukraine will continue to play an important role together with everything else. I think we haven't talked much about sort of Yemen and so on, which is actually increasing the price of shipping quite significantly at the moment. But at the end of the day, I think it's the economy and the demand that will determine what happens rather than OPEC cuts.
Bora, sorry, I'm gonna ask you for your thoughts. I've got a terrible thing stuck in my throat. So please, Bora, your thoughts for the new year.
Yeah,
What carries through?
I also think OPEC has to adapt to the winds, and they're not going to be able to, I think the main thing is the economic outlook for China, which we can all discuss and learn a lot from each other about, because it's not the most transparent situation compared to Europe and the United States. The U.S. is and was in a Goldilocks zone even before the Fed announcement. It was in the best of all possible worlds, and with the announcement, and the dovish tone of that announcement, certain animal spirits were unleashed that set the markets flying. So I don't think Biden is going to get any further uplift, because he's not doing well in public opinion surveys, given that the U.S. economy is roaring, right? It's not going to be doing any better. It's the Europeans and the UK that really needs a dovish outlook and a growth impetus, which is lacking because, for example, Britain is stuck with a 4.7% inflation, and there's no credible prospect of rate cuts for the moment. So that being said, I think the uncertainty factor is on Asian and Indian and African demand. That's where we need to do more analysis and understand how much fossil fuels that area can absorb. But at the same time, what I'm getting out of COP28 is that certainly India and China in a big way is implementing the energy transition. There are very interesting developments in solar storage, electrification, grid balancing, and it's going to
it does clearly seem that China is using this moment both from a regime point of view to tighten its control on this very large country and population, but at the same token to change the economy. And so they're not going to, I mean, it's obviously December 15th. They haven't done it yet. So waiting for Godot to unleash the cannon of dollars to build a highway 10,000 miles in that direction is just not going to happen this time. And this is a moment, I think China will take the pain, if that is what you want to call it, to transition in the direction that they want to try and go to in a more high value economy. So I wouldn't be waiting in 24 for stimulus. What I'll be watching over the course of this holiday season is unfortunately what I consider to be a rogue state in now the Israeli government, and their predictable, or obviously unfortunately predictable behavior being so, but the facilitation of this rogue government and what they could, I mean, we had on Sky News yesterday the ambassador to the UK putting a stake through the heart of the two-state solution. I mean, in no unequivocal terms, with a very big punctuation point at the end of her statement. This is I think, a very dangerous moment for this, and we're seeing that fracture emerge with Washington and Tel Aviv, that this rogue actor, which is not the Israeli people, is this particular Israeli government, and what they could or be willing to do. We've clearly seen that so far. What they could be willing to do while we're all a little bit distracted over the holiday season, I shudder to think. But that would be one of the things I'd be most concerned about going into this window where we'll be off, or what I'll be watching, is how much this rogue state continues to get away with, or does the world wake up to the fact that this is a very particular group of people that have had a very particular agenda. And I mean, there's only a few months ago that half of Israel was on the streets demonstrating against them. We need to see that voice back, because otherwise this could be very, very problematic. That's what I take into this break period, and obviously it's not joy and bells, but nonetheless, it's the reality where we're at. As always, the amazing Bora Barryman, Adi Imsirovic, and Carol Nachley. Wonderful to finish off 2023 with you. I won't ask you what you think the oil price will be. We'll save that till the new year, January 10th, where we'll all gather around the fire and give our crystal ball outlook for the year ahead. The 12-hour swing around the world global energy outlook forum. It's unique. It's unparalleled to anything else. And one day gives you a large bucket of thoughts. So we look forward to seeing you guys then. Have a great holiday season and all the best. Thank you so much.
Thank you. Bye-bye.
Happy holidays.
Cheers. Happy holidays, guys.